Thank you for joining me for the Matthew Douglas Model Portfolio Update. We will have a look at markets over Q3, as well as two of our models and funds used. So first of all, markets. The summer proved to offer a difficult environment for investors in equities. By the end of the summer, the markets had pulled back some of their losses to enter quarter flat. In the US, the Fed cut interest rates in July and September. This was their response to a slowdown in the rate of growth and hiring. Consumer confidence also declined for the higher levels over the quarter. In Europe, the ECB reacted to a weaker economic outlook by cutting rates like the Fed in the US. This pushes rates further into negative territory. Quantitative easing and a commitment to continue with asset purchases has been made at least until its inflation target has been met. This policy easing came against a backdrop of weakening growth, with business surveys for September painting a picture of an economy that continues to slow, particularly in manufacturing. In the UK, Brexit continued and continues to drag on, with legislation being passed that forces an extension in the event of us not being able to agree a deal with the EU. We saw sterling strengthen. We now have the continued Brexit saga being supported by an election, which for now adds more speculation and uncertainty. Although other central banks have taken action to reduce rates, the Bank of England has kept its base rate at the same. The thought process that if global and Brexit risks subside in the future, the potential for an interest rate rise could be on the cards. This is prompted by the 4% wage growth that the bank has seen. China's economy continued to slow, with industrial production at 4.4%, which is down from around 7% at the start of 2018. Retail rates showed a similar pattern. With growth still comfortably above the US and the US showing a slowing economy as a result of the trade dispute, it's far from clear that China will concede to the US demands on trade. Now we will consider the performance of our realistic and cautious portfolios. Over the past 3 months to the 8th of November 2019, we've seen the realistic portfolio increase 2.02% net of fees, and the cautious portfolio over the same period produced a 0.85% return net of fees. Over the 12 months to the 8th of November 2019, we have seen the realistic portfolio increase 8.09% net of fees, and our cautious portfolio over the same period is up 6.66% net of fees. So finally, onto the funds used in our models. Over the 3 months to the 8th of November 2019, our top performing fund has been Royal London UK Equity Income, delivering returns of 7.17%. Over the same period, the worst performing fund has been Jupiter European, with a loss of 4.36%. With investors being concerned by Brexit and trade disputes in the US, we've started to see elements of change in investors focusing from growth to value companies. Although this hasn't meant that growth stocks are falling off a cliff, the nervous and uncertain nature of investors recently has meant that for some, seeking safety in stocks that offer a reliable dividend in return for the risk taken is more attractive, and this has seen the positive returns in the Royal London Fund. Jupiter has seen outflows from their fund following the exit of manager Alexander Darwell in July. Having spoken with Jupiter, we received the following commentary. The overarching message is that there will be no cliff edge sell-off of holdings on the 1st of October, but there will be some changes made to the portfolio in line with Mark's own style, Mark being the new manager. It goes without saying that we think Mark is the natural heir to Alexander, and our team-based approach moving forward will provide no succession issues in the future. It is also worth noting that Mark's positions usually run to 7%, so the concentration of the top 10 holdings will reduce, although the top 20 stocks will remain a similar weighting, and this should reduce volatility. So over the past 12 months to the 8th of November 2019, the top performing fund was Aberdeen Standard Investments Global Real Estate Shares, which was formerly called the Global REIT Fund. This produced a return of 18.72%. Over the same period, we found the worst fund to be the Schroders UK Smaller Companies Fund, which has lost 1.2%. Aberdeen Standard Investments Fund has benefited in investors using REITs, real estate investment trusts, for those high-yielding qualities. As Aberdeen Standard Investments also hedged the currency exposure back to sterling, this has meant a profit has been made from a stronger sterling. We've kept the fund in the models for some time during periods of poor performance on the basis that it has the currency hedge and so would offer value to the models if and when the pound strengthens. Schroders have had a tough 12 months, and we highlighted this in our previous portfolio video. The manager's move from some of the growth stocks to value has meant it has lagged behind some of its peers. This at a time when the sector as a whole has been suffering because of the UK domestic focus. However, since September, we've seen a recovery in the performance of Schroders from being over 5% down in the last 12 months to now only being 1.2% down. We continue to support the funds used in the UK, and particularly Schroders, for their approach to buy the right stocks at the right price. Going for growth at any price doesn't make sense in the current global economic environment. We've also reviewed the UK property exposure in the models. For those investors that are cautious or even lower, there is a large exposure to the Legal and General UK Property Fund. We've decided to partner this with another Aberdeen Standard Investments fund, which is called the Global Real Estate Fund. This one being different from the fund we already use in that it actually buys bricks and mortar rather than relying on investment trusts. What we found is that the increased global diversification of this fund has helped to offer some higher returns, considering that not every economy in the world has an event like Brexit on its doorstep. And that concludes our portfolio review. I look forward to updating you in 2020.